All right, guys, it's not every episode that we start with a mea culpa, but we're going to be doing year-end tax planning for 2021. And I remember viscerally doing it for 2020, and the episode was appreciated, but the feedback we got was, guys, I wish you had given us a little bit more time to process this. I think we were doing it literally going into the last week or so of December. And while I think it's critical that we do this type of episode on an annual basis, we're going to commit to you when we do these episodes to make sure we give you enough time and notice to actually take action on it. So we've invited Sean Mullaney, Buy Tax Guy from buytaxguy.com to join us back on the show today and help you lock in your 2021 year-end tax planning events for members of the FI community. Welcome to the ultimate crowdsourced personal finance show. This is ChooseFI.
You're listening to ChooseFI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. ChooseFI, your home for financial independence online.
All right, guys, very excited to dive into this week's episode. And to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I am doing quite well. Yeah, it's always a treat to have Sean back on the show, of course. And like you said, most importantly, we're not waiting until the absolute last minute this year. So we're giving people good 45, 46 days here ahead of publication date to make some changes for the December 31st deadlines. But as Sean is certainly going to go into, there are some deadlines into 2022 as well. So you have plenty of time this year, which is nice. And yeah, Sean, with that, welcome back to ChooseFI.
Brad, Jonathan, always great to be here. Thanks so much for having me.
Well, let's start by saying that Brad, in his newsletter that went out this past week, referenced your article on 2021 year-end tax planning, and it was your most trafficked article ever in the lifetime that you've been writing on the website. So it shows that there is significant interest in this exact topic, and we've had a lot of stuff that's happened over the last year. So where do we tackle this? Do we just start by saying there's things that we should do every year, and we'll get to those, but let's talk about what's different this year?
I would recommend, let's start with talking about what's different this year. And to my mind, the big one for folks in the FI community is the deadline for the Backdoor Roth IRA. Let's just step back. I know we have a lot of new listeners in the ChooseFI audience. What is a Backdoor Roth IRA? It's a transaction for those folks who make too much money to make a regular contribution to a Roth IRA. The idea is you first make a non-deductible contribution to a traditional IRA, right? That's $6,000, $7,000 if you're age 50 or older. That's no big deal. That doesn't move the needle too much in terms of tax or retirement planning. But the second step is where the elegance comes in. Many people can then do a second step where they do a Roth conversion of the amount in the traditional IRA. And if done properly, that second step does not create any additional income tax. So for higher earners, it gets money into Roth accounts when they otherwise would not have been able to do so. And the other thing that's also nifty about that transaction is folks in that situation typically cannot deduct a traditional IRA contribution anyway. So there's no trade-off. There's no, oh, well, I'm doing Roth, but I don't get this tax deduction. That might be a reason not to do Roth. But in this case, for most high earners, if you don't qualify for a Roth IRA contribution, you probably don't qualify for a deductible traditional IRA contribution. And your best path is probably going to be just this backdoor Roth IRA. Okay, that's great. In previous years, the practical deadline on this thing has been April 15th of the following year, right? So, there's folks who do it January 1st, right? They wake up New Year's Day, they do the first step of their backdoor Roth IRA, they're all excited. Great, good for them. But as a practical matter, that wasn't required. And you could wait until the following April 15th to do the first step, which is the contribution to the traditional non-deductible IRA. Things have changed from a planning perspective this year. The reason being, and I've blogged about this, there is a proposal in Congress right now to eliminate the backdoor Roth IRA as of January 1st, 2022. All right. So on January 1st, 2022, you couldn't do the second step of that backdoor Roth IRA, which is the Roth conversion piece. And that's where this transaction gets its attractiveness. Okay. So if we can't do our Roth conversion after January 1st, that effectively is telling us if we qualify for a backdoor Roth IRA in a tax efficient manner, what we ought to do is we ought to do it before December 31st of this year. And again, the law has not yet changed, and it very well may not, right? This is very speculative, and this show isn't about political prognostication. But it's like, hey, wait a minute. This is a risk that's out there that the law could change. So I know in previous years, I could have waited to January, February, March, early April. This year, I'm just going to go ahead. I'm going to get my ducks in a row. If this is the right thing for me, and do my backdoor Roth IRA for 2021 before the end of 2021. That's the big change that I see for so many members of the FI community this year.
Yes, Sean, I love that. So that's just kind of a way to approach decision making. This I see as a free roll, as we'd say, right? There's no downside whatsoever to doing it by 12/31. And there is a potential significant downside to waiting, right? So therefore, obviously, if you have money saved up, you're waiting to pull the trigger on this. Why not do it before 12/31? Like you said, there's a proposal in Congress. We hear proposals all the time and they fall through, they go through. We can't prognosticate that. But like you said, there is no downside if you're going to do this to do it by 12/31.
Well, yeah, let me talk about the downside for a quick sec. So in my year-end tax planning article, I have this commentary about, well, wait a minute, I'm not sure if I'm going to qualify for my regular Roth IRA contribution, right? I don't know what my year-end bonus is going to be. I don't know what my year-end interest dividends are going to be. So I'm right on this border of, they call it modified adjusted gross income limit for a Roth IRA contribution. What do? You're telling me I can't wait to December 31st. I'm now in this sort of odd boat. Here's the thing. There's really no drawback of doing a backdoor Roth IRA in a year that you otherwise would have qualified for a regular Roth IRA contribution. So in terms of the decision-making and downsides, if you would have qualified for a regular Roth, but you can also do the backdoor Roth, 2021 is this unique year where you might just want to do the backdoor Roth, be done with it. And then if you get to tax return time in 2022, I would have qualified. Well, who cares? There's no real negative material downside. The only other downside potentially is this December 31st. I have a whole separate article on my blog about December 31st and the backdoor Roth IRA. We just need to make sure if we're going to do a backdoor Roth IRA before December 31st, that you don't have any other traditional IRAs, SEP IRAs, or simple IRAs. Where most people get into trouble with this is, I used to work for XYZ employer, back in the day. I left them 5 years ago and I rolled the 401k into a traditional IRA. There's nothing wrong with doing that. However, that probably means that the backdoor Roth IRA for you is not a good transaction. So there's issues around just making sure that the only traditional IRA you have is the one that you use to facilitate the backdoor Roth IRA itself. That's like where you could have a downside to this transaction, but that's sort of just check the box, make sure your profile is the right profile for the backdoor Roth. And if it isn't, there are other ways to achieve your financial goals.
Can we help clarify the profile here, though, just so someone has an ability to kind of, decide whether we're moving on to the next checkpoint or this is really the highest impact thing that they could be focused on? So there were a couple of variables that I heard in there. One was understanding that modified adjusted gross income cutoff. And then the second variable, and you could probably add a third and a fourth, would be, do I have a smattering of retirement vehicles that are lying out there from past employers? And this has to do with pro rata rules and mixing pre and post tax and all this sort of thing. With regards to the second one, and I'll go back to the first one for you, but with regards to the second one, if they acknowledge that they do have the smattering, the cornucopia, all the retirement accounts, all the things, is it too late to clean it up? Or should it have been done last year?
Great questions, Jonathan. I'll go with your first one first, right? The profile is, if you're single and your modified adjusted gross income is $125,000 or more, the backdoor Roth is probably where you're going to be looking to turn to, right? If you're under that $125,000 in terms of modified adjusted gross income, and this is generally W-2 income, interest, dividends, capital gains, self-employment income, if you have positive rental income, those sorts of things. If you're above 125, you're going to want to think about the backdoor Roth if you're single. If you're above 198,000 in terms of modified adjusted gross income, if you're married filing joint. So that's the first guidepost in terms of the profile for someone who this might make a lot of sense.
Before you move on, 2 additional points. Question, capital gains. I heard you mention different types of income. What about someone that capital gains is adding to the income? How is that going to, what's the interplay there between that and modified adjusted gross income?
Yeah, capital gains goes into that number.
Okay.
Right. Yes, capital gains, long-term capital gains are tax advantage, right? They qualify for a better tax rate, but they also increase your modified adjusted gross income. So if you happen to have some capital gains this year, those could push you over this 125 number, single, 198 number, married, filing joint. That's part of the reason I'm saying you want to act now versus waiting to next year. And look, it may be that nothing happens and then you waited to next year and it's going to be okay. But from a planning perspective, I don't think that makes sense. So that's the first piece of this profile is this modified adjusted gross income.
And one more piece I want to add on it. So we just talked about what might have the unintended consequence of raising your modified adjusted gross income beyond what you would have expected when you're just looking at my income. But the other is actually decreasing it. You can decrease your modified adjusted gross income by funding, and this is the problem, by funding your 401k. So tell me like the interplay there. So someone was able to reduce their modified adjusted gross income from, let's say, 130 or 145 down to below the threshold you just mentioned by funding their 401k. What are the implications of that?
Jonathan, great point, right? So it might be that, hey, I'm on this borderline. I'm not so sure. But if I jack up my 401k contribution at the end of the year in December, now I might get under that 125, if I'm single, that 198 if I'm married, filing joint. And this is one of the advantages of having a FI mentality is maybe I've built up other savings, a nice emergency fund. And so look, I can cash flow December 15th paycheck through my own savings and just jack up my 401k contribution. The other thing is there might be some folks still in open enrollment right now. And the HSA is a great mechanism to lower taxable income as well. We've talked a lot about the health savings account, the high deductible health plan on the ChooseFI podcast in the past. But if you get in by December 1st and the high deductible plan is your only health insurance, you can qualify actually to max out the HSA for 2021 too. Both money that goes into a traditional 401k and money that goes into an HSA can reduce your modified adjusted gross income. And this is one of those reasons why folks like to reduce their modified adjusted gross income. It can open the door for a regular Roth IRA contribution.
Last tiny point here, just because my brain kind of goes in circles and I get all this stuff muddled and I like to have a little bit of clarity on a topic that's very important, highly profitable and valuable if you understand it. But we mentioned something about pro rata earlier.
Yes.
And I want people to be able to have the clarity, that line of distinction. When we're talking about pro rata, we're talking about individual retirement accounts, not to be confused with your 401k and your HSA. Right? Your current 401k and your current HSA, that will reduce your modified adjusted gross income. It will not muddle the pro rata pot. Whereas all these leftover things, like you left an old employer and that was now into some sort of rollover IRA account that you carried with you, that's where things get messy. And that's why we're talking about cleaning all of that up. So Sean, that was profile 1, the first piece, part 1. I know there was a second part we were going to talk about as well.
Yeah, the second part is this issue around old retirement accounts. Right. So old traditional IRAs, SEP IRAs, and simple IRAs go into that pro rata rule. Everything else you mentioned, workplace 401k, 403b, 457, Roth IRA even, and HSA, all that stuff doesn't go into your pro rata rule. The only things that go into your pro rata rule are your own traditional IRA, your own SEP IRA, and your own simple IRA. It's just the way our U.S. tax rules work, right? It's this crazy system, but it's just the way this pro rata rule works is it looks at all your traditional IRAs, SEP IRAs, and simple IRAs. It's those 3 and nothing else. Is that the way the world should work? I have no idea. Probably not, but that's the way the world works. That's just the rule, and you have to understand that. So what it means is if you want to do a backdoor Roth IRA, you ought not at December 31st have any of these traditional IRAs, SEP IRAs, or simple IRAs. And if you do, then look for other planning mechanisms.
Yeah, and Sean, that's my exact scenario. This always seemed, it was just way too complicated because I have traditional IRAs and I have a SEP from another business. So it just, the juice wasn't worth the squeeze in essence for me. So I just didn't bother. But like you said, for someone who doesn't have that, who is over those income limitations, this is something they should definitely consider. And I guess I wanted to have just a slight pivot because when we're talking about backdoor Roth contributions, a lot of people think and conflate it with Roth IRA conversions. Has anything changed now, regardless of future proposals, but has anything changed on Roth IRA conversions in 2021 or going forward?
So in 2021, very little has changed in terms of Roth IRA contributions or conversions, sorry. The one thing I will mention is for those early retirees in the community, sometimes a governor on Roth conversions in early retirement is something called the ACA Premium Tax Credit, right? This is the tax credit that folks get if they have an Affordable Care Act plan. In every year other than 2021 and 2022, if your modified adjusted gross income goes above 400% of the federal poverty level, it's a cliff. The second it's $1 over, you get no premium tax credit. If you're right at 400% or less, I believe 400 is the exact demarcation. As long as you're less than that, you still can get a substantial premium tax credit. So some folks in early retirement are like, oh, I'll do some Roth conversions, but I got to be real careful because that could be thousands of dollars of premium tax credit. Other than that, though, for 2021, go right ahead, do Roth conversions as long as you want to. Understand that that's taxable, but sometimes this is part of a tax rate arbitrage. You're in a high tax rate when you're working, you get to early retirement, and you say, oh, look, I don't have that much taxable income. I'm going to do Roth conversions at this point.
Yeah, and I love how you talked about the interplay with the subsidies, because while you might have some space theoretically in your lower tax brackets to do the Roth IRA conversions, which you said that is a taxable event, you don't want to get that taxable income too high because then you might be...
And I'm sorry, I got a little lost in the weeds there, but my point is for 2021 and 2022, that 400% cliff has been eliminated just for these 2 years. So you can still get some premium tax credit in these 2 years only, and that could change in the future. But this was part of a tax law change that happened earlier in this year. So this year, it's not as imperative to walk up to that cliff and stop, right? So you always want to work with your own tax advisor, your own tax planning on this. Your mileage may vary, but that's a big rule change for 2021 and 2022 is that 400% absolute cliff has been eliminated. So folks who are above it are still going to get some premium tax credit, though it will be diminished as you increase your taxable income.
Sean, this is a nuanced question, but I'm curious your perspective on it. When we talk about doing things like funding a Roth IRA, it's relatively simple proposition. You just do it through a brokerage account. And, assuming the limits are all in there, the brokerage account asks you, hey, are you going to be above or beyond? It's pretty much just this. The Backdoor Roth does have some additional forms that are filled out. And I'm curious, in your experience from what you've seen, are people in the FI community, are any significant percentage of them doing this on a DIY basis, or is this being done with significant handholding from an accountant? I'm just curious, in the realm of simplicity, is this something that's doable from a DIY perspective?
I believe it is. Now, it may be that so there's a form, Jonathan, called the Form 8606. And this is where folks sometimes get astray on their Roth IRA conversions, right? So what you need to do is on your Form 8606, you need to report your non-deductible traditional IRA contribution. That's easy to do. $6,000 contribution. That is very easy. The tax return prep software, even for DIY, is pretty good on this. And then separately on that Form 8606, you need to report your Roth conversion. And if the Roth conversion has been done correctly for a backdoor Roth, it should spit out either 0 or 1 or 2 or 10, very small number of tax for taxable income on that conversion. This is absolutely doable from a DIY perspective. That said, sometimes folks DIY it and they get it wrong. I've seen it where, hey, you DIY it, or sometimes even paid preparers get it wrong, right? So there's, nobody's perfect in this life. It can be amended, right? So these things can be fixed. Nobody's going to jail because they didn't file the 8606 properly. You always should endeavor to do it properly. In fact, I've actually blogged about this. I have a blog post entitled Fixing Backdoor Roth IRAs, where I talk about how you do this 8606 form. It's not that complicated, especially once you've done it once or twice.
Okay. And so in your mind, best resources for someone that's trying to research this further and wants to just see what's involved and what the process is. Have you blogged specifically about the process? Have you encountered other tutorials that you find, valid to look at for reference?
Yeah, I'll give you 3 resources, right? One, I'll self-promote, shameless plug here, but I myself have done two blog posts you might want to look at. One is on Backdoor Roth IRAs in December 31st. I have 3 screen grabs of 8606s and part of them and what that might look like. The second one is just the IRS instructions to Form 8606. They're pretty good, right? So you can literally just Google the IRS instructions for the Form 8606. And I know the White Coat Investor has done some tutorials around the Backdoor Roth IRA. And look, I'm not here to say every last word on any resource is going to be 100% accurate, but I am here to say that that's a pretty in-depth resource. You can Google, I guess, White Coat Investor Backdoor Roth tutorial, and I believe he's got some content around the 8606 as well.
Hey, Sean, something you said a minute ago was interesting about amended returns. Now, that might be a concept that is completely new to the vast majority of people listening. Now, you and I, both CPAs, we've been doing this. We understand you can amend returns. Can you talk just really quickly at a high level of the timing, when the statute closes, why someone would amend, and just give some flavor on that whole process?
Yes. So, Brad, you are absolutely right that, you file a tax return and it may be that you later discover an error or an omission or both, and you say, hey, I should amend this tax return. So, few parameters, right? Generally speaking, and this is very general, is that for federal purposes, there's a 3-year statute of limitations. Basically, if you file before April 15th, you march up to the April 15th for the year of the tax return, add 3 years, and that's your window in which you can amend that tax return in most cases. If you file after April 15th, you generally start on the filing date. Maybe you're on extension. You start on the filing date, add 3 years. That's they call it the statute of limitations. And that's the time frame you can amend a return. Why would you want to amend a return, right? The first reason is because, hey, I missed a tax deduction, or I misreported my backdoor Roth IRA and I paid tax on the Roth conversion that I shouldn't have paid. I want to I want to report this additional deduction, or I misreported this backdoor Roth. Hey, I overpaid my tax this year. I want to submit a new tax return and have the IRS and the state taxing agency give me refunds because I overpaid on my taxes, right? There's a second reason. You might find I made a mistake and I underpaid my taxes. And so you're probably in a situation where at that point you're going to want to reach out to a professional, if for no other reason than you don't want it to happen again, right? One thing to resolve the current issue, but it's also, hey, I just want to make sure this doesn't keep on happening. In those cases, you want to assess, hey, what was the mistake? How material is it? What's my risk, in terms of interest or penalties on this, right? So sometimes you might want to amend a tax return because you're like, look, if this gets discovered and I got to pay not only the tax, but interest maybe, and if applicable penalties, usually it's not going to be a penalty situation, but it absolutely could be a penalty situation, that you got to talk to your own professional about. So you might want to just cut those things off, right? Generally speaking, if there's an honest mistake, there's no affirmative obligation to amend a tax return, right? So the law doesn't necessarily require you to amend a tax return that has an honest mistake in it, but you still might want to think about doing so for various reasons.
Thanks, Sean. That was a great explanation. And yeah, just a concept that we've never spoken about on this podcast. So I think it's really important that people know that option is out there. Like you said, both to the good and to the bad, if you will, right? Paying more tax, but doing it right. I think
Yes.
that's the ultimate key here.
We spent a lot of time talking about backdoor. We just kind of briefly moved on to amended returns, and we'll keep going here in just a second. But I did want to talk about the individual that recognizes that they do have money in various accounts, but they also recognize that the backdoor Roth could be an incredibly viable tool for them based on their income bracket going into the future. And they want to go through the process of, effectively remediation, cleaning up all of these laggard accounts. That could be the action step for this year. What are their options? Is it basically because they have this, no, the backdoor doesn't work for them, or is there action steps they could take, this year to prepare themselves for 2022 and beyond?
So there absolutely are potential actions that can be taken. And where that usually lies is an employer 401k or other workplace retirement plan. So the way you would get yourself in a position where you could do a backdoor Roth IRA under current law, right? This could change, but under current law, what you would do is you would take your old traditional IRAs and you'd work with your current IRA provider and your workplace 401k, 403b type provider, and say, hey, I would like to do a transfer of this traditional IRA into my workplace 401k, 403b. And what that does is it cleans you up for purposes of this backdoor Roth IRA rule. Two real quick points on that. One, if you do that, you want to effectuate what's referred to as a direct trustee to trustee transfer. You don't want to receive a check, generally speaking. You want to try to do it through a direct trustee to trustee transfer. So the money just moves from one account to the other. You never see a check. You never touch it. Second thing is, sometimes these things take time, right? Different 401k plan providers have different levels of customer service in terms of current employees. And it may be that you don't have enough time to fully get this executed by December 31st. What I generally tell folks is you want to clean up before you do the backdoor Roth. And maybe this is more of a long-term play. So maybe you say, look, I'm going to start soon and try to get this cleaned up, get this old traditional IRA into my workplace plan. And hopefully it happens sooner rather than later. If it happens later, then maybe I can't get 2021 done, or I do 2021 in 2022, assuming the law doesn't change. The other thing just to keep in mind is maybe you're very satisfied with your traditional IRA provider. There are many financial institutions now that offer low-cost mutual funds, great diversified options, and maybe your 401k plan just isn't that good. Now, I will say my experience is that 401k plans are getting better and better in terms of investment fees, in terms of investment menu. But, not everybody has a great 401k plan. So you might say, oh boy, I really like the investments and the expenses in my traditional IRA. I don't like the investments and the expenses in my workplace 401k. So you know what? Backdoor Roth's a great idea. But based on the investment menu and based on the investment expenses, I'm just going to leave this money in the traditional IRA and I won't do a backdoor Roth, and I'll be okay with that. So it's a multivariable calculus, but I think those points, are good to remember. Just compare your IRA options to your 401k options from an investment perspective and expense perspective. If you do it, do a direct trustee to trustee transfer. And also think about the long term as opposed to just focusing on 2021. Sometimes this is more of a long-term play.
Hey, this is Andrew from the ChooseFI team. Hope you're enjoying the interview. We're going to get right back to it right after these quick messages.
So, Sean, I was given a talk recently, and I was talking to this group of contractors and freelancers, and the topic came up of the solo 401k. And I know this is a topic that's very near and dear to your heart. I know that we're working with you to bring a book into the world, really talking about this exact strategy, this tax strategy, this tool that is massively underutilized. And I'd like to give you the floor to talk about it generally and as it applies to year-end tax planning.
Yes, a solo 401k, it's the retirement account for the new workforce, right? So for those who are solopreneurs, myself included, right? I'm a pusher and a user of the solo 401k in my own life. The solo 401k is a very powerful tax advantage retirement account. It takes the 401k and it brings it to your solopreneurship. It brings it to your self-employment in a way which is very powerful because you can do both employee and employer contributions. The numbers can get very high, which is great. And, as it applies to 2021, I think there are two things that are on the table. One is what we've already talked about, right? Lowering your AGI, your modified adjusted gross income, to qualify for this so-called backdoor Roth IRA. The second thing that's on the table is in early 2021, there was a third stimulus passed, and that opened the door for additional tax stimulus in 2021 and additional child tax credits in 2021 if you can get your modified adjusted gross income below certain thresholds. Generally speaking, $75,000 if you're single, $150,000 if you're married filing joint. So let's say, you're looking at your taxable income for this year, you're married, you're filing joint, you didn't get a stimulus check on the third round because your income last year was 160. You're looking this year, you're like, oh, it's about 160 this year, but I haven't done a retirement plan for my self-employment. Maybe you open a solo 401k, make a traditional contribution, and you knock that modified adjusted gross income below 150. You got a tax deduction. Great. We all love tax deductions, right? But even better, you've opened the door to additional stimulus and additional child tax credits if you have qualifying children. So I think this year, solo 401k, it's something to think about like right now is if I'm self-employed, I want to think about, do I have a solo 401k? For some people, you have a small business, you have 8 employees, solo 401k is probably not going to work for you. But there are plenty of solopreneurs, plenty of side hustlers out there. This is the sort of thing you might want to think about for 2021, especially because of that third stimulus that got passed in early 2021 and the additional child tax credits.
So you glossed over this, and I think maybe gave you the tiniest bit of a teaser reel there, but I think it's worth coming back to. So most of us think about the 401k, and we think about the contribution limits of, is it 19,500 in this year, maybe going to 20,000 next year? Okay. But we also, on almost any sort of personal finance course or lesson or tutorial that you would take, say, does your employer have a match? Does your employer have a match? Do they offer you a 5% match? Because a lot of times you can, if you will contribute, 5% of your salary to your 401k, your employer in many cases will match that, in some cases dollar for dollar. So you get, you're unlocking an additional 5% raise, basically. This is money if you don't do the match. So for many people who aren't doing that, go do that. That's the biggest, highest impact thing that you can do. All right, great. But you just said, if you do a solo 401k in this unique situation, you are the employer and the employee. And so in that scenario, the employer was the one that decided how much the match was. And they weren't limited to 5%. They could have done 5% is very generous. You should take every penny of that, but it could be more generous. So Sean, help me imagine here, if you have a business that's profitable and you have a solo 401k, so you are the employer and the employee, how you might utilize the tax code to maximize the power of the solo 401k.
Great question, Jonathan. So for those who are self-employed and report that self-employment income on Schedule C, that Schedule C is a big driver of the tax benefit. So imagine you have a Schedule C that reports a little over $100,000 of self-employment income this year, okay? What you do is the first contribution you can make is the employee contribution, and that's going to be up to $19,500. Plus, if you're age 50 or more, you can add another $6,500 to that number. So It's actually $26,000. So that's one option. And the cool thing is you actually have two options, and you can max out. You don't have to max out, right? So you now have, if you have that over $100,000 Schedule C, and it doesn't even have to be $100,000, but I'm just positing one example, that person can make $19,500 as an employee into a traditional or a Roth solo 401k. But it gets even better. So let's say that person, computes their Schedule C and it's a little over 100,000. There's a deduction on the tax return for half your self-employment tax. So you're probably familiar with, I'm sure you guys are, when you're self-employed, not only do you pay income tax, you pay self-employment tax, which is essentially the equivalent of FICA tax for W-2 employees. So self-employment is great, but it's a great way to pay more tax. Okay, but you do get this deduction for half that payroll tax, that self-employment tax. So let's just say you add up Schedule C and you subtract out that deduction for your payroll tax, and the net number is $100,000 on the dot. Okay, you then take that $100,000, that net number, and now you just do an employer contribution to your solo 401k up to 20% of that net number. So what have we done, right? For somebody who makes a little over $100,000 in self-employment income, they could do $19,500 as an employee, maybe $26,000 as an employee, plus up to another 20%. So that's $20,000. So that person could do this year $39,500 into their solo 401k through employee and employer contributions. Okay. This is one of the challenges of editing a solo 401k book, is getting all the employees and all the employers correct. But you see the magnitude, right? If you go to work W-2 job and you make a little over $100,000, that's fantastic. How much are you going to get into your 401k? Probably the 19.5 plus, a 5%, 6% employer match. That's $25,000. That's fantastic. But for my self-employed person, we just got almost $40,000 in there, and about $46,000 if we're age 50 or more. So, Jonathan, your point is well taken. The combination of both the employee and the employer contribution to the solo 401k can make it very, very impactful.
So, to add on to that, my understanding, looking from the sidelines on this one, is that if you were to do this, what you do for one person, you have to do for everyone. So you can see why your S&P 500 company is probably not going to give everyone, is not going to give, themselves necessarily this extra $30,000 or $40,000 of match, because they would have to do it to everyone in the company, and the company just won't bear that. But you as an individual with a company of one can pull this off. And Sean, I would say there is some like you can't just do 20% if you're making, $1 billion a year. There's some cap on the total amount of money that can hit the pot. But also, it's my understanding, if you're filing joint, can't this extend to an employee that is also, a partner as well?
Absolutely. So yeah, there are limits here, right? So the overall, I call it the all additions limit. The overall limit for solo 401k in 2021 is $58,000, right? You have to make a good amount of income. It's not millions of dollars to get to that $58,000 limit, but that is a very healthy limit for a retirement plan. And then that limit goes up to $64,500 if you are 50 or older.
And Sean, when you're talking about that 58,000, that's all inclusive. That includes the 19,500. That's the employee contribution, correct?
That's right. I call it the all additions limit because it's all the additions during the year into the solo 401k, employee contributions and employer contributions. It's not the investment growth. That's totally separate. I'm just talking about the contributions during the year. And Jonathan, to your point about marriage, yes, if your spouse works in your trader business, it is absolutely possible that they too can participate in a solo 401k, which is very exciting as well, because it may be that the spouse is only a very part-time person in that business. Maybe they're not. Maybe it's, husband and wife. They're both going crazy on the self-employment and they both can max out. But maybe it's, one spouse just does $10,000 worth of work during the year for the business. Okay. That spouse maybe makes an employee contribution of up to about $10,000. That's still pretty good tax planning, at least where I come from. The one thing just to keep in mind is if you have a side hustle or like a arrangement like part-time like that, is the $19,500 has to be coordinated over all employers, right? So if you go to, Big Corp USA and make $15,000 of 401k contributions as an employee, that's great. That limits the employee, not necessarily the employer, but the employee contribution for the rest of the year for the solo 401k to $4,500 in my quick example. So another thing just to keep in mind, you could see that this does get a little complex. It definitely benefits from some analysis, and that's part of the reason we're working on the book.
And also, so like our action step, we wanted to give you the framework. We wanted to get you a little bit excited about the idea. There's some of you that have been saying, I need to set up a solo 401k, but you haven't taken it seriously and you just haven't done it. And so just from this perspective, your giant year-end tax planning opportunity here is to work with your accountant to get a solo 401k set up. I guess you could do it on your own technically, but a lot of people would benefit from working with an accountant to set that up.
And Sean, does that have to be set up or should it be set up by December 31st?
Brad, generally speaking, yes. The planning should be happening already. It's not too late if you're listening to this in mid or even late November, but you definitely want to be setting up the solo 401k sooner rather than later. There is some complexity in terms of setup. It's not just like setting up a Roth IRA. That said, it's also not 600 pages of complexity either, right? It's manageable complexity with intention. And Jonathan, you're absolutely right. Many folks are going to benefit from working with a professional in doing so. Not everybody needs a professional, right? It's a judgment call. DIY can work, but oftentimes these conversations are best had with a professional's help.
All right, we're rolling right through this. The other one that I think we should go ahead and spend a few minutes on is talking about charitable contributions, just because there is significant ways to optimize that if you're creating a long-term plan for charitable contributions.
Absolutely, Jonathan. There are two factors in play here. One factor is, I like to give to charity, and I want to do that in a tax-optimized way, and there's some really cool ways to do that. The big one to my mind is the donor advised fund. We keep coming back to this on the ChooseFI podcast. And for the cost involved, I think it's well worth coming back to. And all this is doing is it's saying, okay, what I want to do is I want to get a higher tax deduction in 1 year. And maybe what I do is I itemize this year because I get a higher tax deduction. And then next year, and maybe the following year, and maybe even the following year after that, I just take the standard deduction, which is pretty high now. It's about 25,000 give or take for a married couple. It's actually 25,100 this year, I believe, for a married couple. Don't quote me on that, but
That's right.
Directionally, that's where it is. But my point is, why not take that standard deduction in many years and just gloop all your charitable deductions in one tax year, get a big itemized deduction one time, and then just fall back on the standard deduction? Well, but wait a minute. I don't want to give a lot of money to charity this year and then not give for the next 2 or 3 years. Like, nobody does that. Well, the donor advised fund is the answer, right? So what you do is don't give to the charity directly. You put the money into a donor advised fund. You get a tax deduction up front for putting the money in the donor advised fund. Then you just have the donor advised fund dole out your charitable contributions for 2 years, 3 years, 4 years with the money you put in. There's no tax deduction for those contributions, but you got the big tax deduction up front for the money that went into the donor advised fund. So that's a great way of just arbitraging, using the timing rules to your advantage. Donor advised funds are relatively low cost solutions, right? The fees on them at the discount brokerages are pretty modest these days. It's a very easy planning technique. But then there's the second issue out there. I call it the problem of appreciated stock. So many folks in the audience these days have these cats and dogs, right? I worked for XYZ employer. I bought something because it was in the news 10 years ago, and the stock has gone through the roof. And now it has a big capital gain. And, for whatever reason, maybe I don't want to have this stock anymore. I've written it out. It's got a big capital gain in it, though. So if I sell it, I'm going to have all these taxes, right? How do I solve that problem? The donor advised fund is a great way to do that, right? Hey, you're going to make charitable contributions anyway, assuming you're charitably inclined. What you can do is work with your financial institutions, move the appreciated stock. Don't sell it, just move it into the donor advised fund. What's going to happen is the donor advised fund itself will sell that stock, but the capital gain is forgiven, right? There's no capital gain on that, and you get a tax deduction. So I think there are a lot of folks in the audience, especially in the early retiree community, who shouldn't be giving cash to charities anymore. What they ought to be doing is move appreciated stock into a donor advised fund and then just give cash donations out of the donor advised fund to charity. Now, you can actually directly give some charities the appreciated stock, achieve the same thing. A, not all charities will accept it, but many do. And B, it might be, look, I'm going to move 5,000 of appreciated stock to the donor advised fund and then slowly over time give them $100 donations, $200 donations, that sort of thing. So I think this could be, there's some real play in the joints out there for members of the FI community to optimize from a tax perspective charitable giving.
Yeah, Sean, that's awesome. And to be clear, you said, and you get the tax deduction, and you get the tax deduction of the fair market value, right? The current value of that appreciated stock, and that huge, potentially huge, in your example, that huge unrealized gain. And Sean, that's a permanent difference, right? You're never paying the tax on that unrealized gain, never. So you are getting the tax deduction for the fair market value of this appreciated stock, and that humongous potential capital gains, that's never coming due on your tax bill.
That's exactly right, Brad, right? You permanently eliminate that capital gain. Whatever the capital gain was on the stock that goes into the donor advised fund goes away. And you're right, generally speaking, you get a tax deduction for the fair market value of the stock you put into the donor advised fund. There are limits on that. I believe it's 30% of adjusted gross income. So you can't wipe away your taxable income to zero. So you always just want to be careful with that. But if you're making a more modest contribution to the donor advised fund, it can be a great planning tool. And, with this capital gain issue, there are folks out there that may just do this even if they take the standard deduction anyway. They may say, oh, that's interesting. I just get rid of this capital gain permanently. I won't even measure. Maybe I still get the standard deduction anyway, so I don't really get a federal tax deduction, but I'm fine with that because I washed away this capital gain. I'm more than happy if that's just the only benefit.
So a couple things here. One is, I think of most people as maybe having some sort of charitable contributions to, it's that $2,000 to $4,000 a year range. Maybe you have monthly donations, and it's kind of coming up to that $2,000 to $4,000 a year is going to charitable contributions. But you just said this is happening in a world where we have these massive standard deductions. So married filing joint, $25,100, this massive standard deduction. You're getting that either way, whether you give a charitable contribution or not, you're getting that just married filing joint. So your $2,000 to $4,000, while well-intended, is not in any way moving the needle on a standard deduction you would have already gotten. So you add in your, what are you paying in state tax and all of these things that you would use to itemize your mortgage interest, all these things you'd use to itemize. You add in your state tax, you add in your charitable contribution, and each year you end up landing with around $19,000 of itemization, $22,000 of itemization, 23, 20, whatever. From a tax purpose, you're getting no real incentive to contribute money to these charities, to these nonprofits. So how can we recognize that that's the lay of the land and get the tax benefit in a world where we're pretty excited about the standard deduction? It's good. We're not saying we don't want the standard deduction to go away. Keep raising it. That's great. Is there a way that we can still on top of that? And then what you're saying is it's timing. Could we use a couple of the options you just said, moving appreciated assets, appreciated stocks, or front loading a massive donation first into, so instead of the 2,000 to 4,000 we do every year, could we find a way of funding it with 20,000, with 30,000, whatever, pick a number, 15,000, 10,000? Could we front load multiple years worth of contributions in the case of that moonshot that you don't trust, but you want to realize the value, you want to reset the basis, but do it in a tax optimized way? Move that in and create a lifetime of giving. Now, that's first of all, just right. I think people hopefully understand that it's a timing issue. We're still going to give the money to our organization on a metered basis, but we're going to try to front load it here. Sean, is there any calculus at which point you would say, well, that's too much because that's all the tax advantages happening in the current year, and I'm only able to, my tax burden was only, XYZ amount, and this is 5 times that. So I'm actually wasting all my energy here. Like, can you roll over the benefits to additional year if you overutilized it, or should you do some math ahead of time to say that's too much? This is the cap on which we're going to put into this year.
Yeah, great question, Jonathan. So first thing to keep in mind is there's no time restriction on using the donor advised fund, which is a nifty rule for us, right? So what it means is if I put $10,000 into my donor advised fund in December, there's no clock that's now ticking like, oh, I've got to spend that money on charitable giving between now and 1 year, 2 years, 10 years. There's just no clock. So that's an important point to make. Second point is donor advised funds are great, but remember, it's a permanent transfer, meaning if I later need to fix my roof, I can't go back to the donor advised fund and say, oh boy, I got this roof repair. Can I get $1,000 back? Doesn't work that way, right? That money is permanently gone. So I think being conservative actually makes some sense. So let me give you an example. You're saying, hey, maybe I added up my home mortgage interest, my state taxes, and my already existing charitable contributions for this year, and I'm getting to like $19,000. And I do $2,000 to $4,000 a year in charitable giving, right? All right, maybe you say, look, I'll put approximately like 3 years worth of assets for charitable giving into a donor advised fund. So let's just call that $10,000. In that 2 to 4 scenario, that's roughly 3 years. So maybe what I do is, toward year end, but also this is the sort of thing that December 31st is the deadline, but you want to get moving because financial institutions sometimes do take their time. Right. But maybe what I do is I find an appreciated stock position that's worth $10,000. Maybe its basis for tax purposes is only $2,000 or $3,000. So it's got a $7,000 or $8,000 capital gain. I don't want to pay tax on that. So I find that $10,000 position. And in early December, I move that into a donor advised fund. I get my $10,000 tax deduction for that. So now my itemized deductions have moved up, from $19,000 to $29,000. So now I'm taking itemized deductions this year. I'm above that $25,100 cliff that Brad mentioned. And so now I'm getting the capital gains excused. I'm getting an additional federal and probably state income tax benefit, depends where I live. And then I'm also now having a cash fund in this donor advised fund for the next 3 years. I fund my charitable contributions out of, and I think it's win-win-win, right? Charities see pretty much no difference. I get this upfront tax benefit, and I've done so in a somewhat modified way, more modest way. So, for that type of person, hopefully 10,000 is not life-changing, meaning, all right, if their roof needs a repair, hopefully they're financially independent enough that, okay, this is no cataclysm, this is no horrible event. I will figure out, I've got resources because I'm FI-minded to pay for the roof repair, and I'm not missing that $10,000 too much in the donor advised fund.
So, Sean, let's go ahead and move on. Let's talk about early retirement tax planning. We're just kind of moving in my mind more to just a general checklist, right? These were big concepts that we were rolling through, just reminding they're so high impact, but now we're these are just things that we should be considering. Or does this apply to you, someone that is on the early retirement bandwagon and they're on the glide path, they're getting ready, or they have just pulled the trigger and they are in early retirement? Does that open up opportunities for tax planning?
Absolutely does. And this is the big thing where it's not about, hey, there's this one great one size fits all answer. This is about having an intentional process in place. If you are early retired, you have a great tax planning opportunity because you have artificially low income. So what I tell early retirees is, look, fourth quarter of the year, October through December, think about your year. How much taxable income did you generate? Capital gains, interest, dividends. And think about Roth conversions. And you'd have to do a bit of a subjective exercise. How much tax do I want to pay? But you're going to be in an artificially low tax bracket between early retirement and collecting Social Security and having RMDs. Great time to do some Roth conversions. Might be a good time to do some tax gain harvesting. I'm not here to say what anybody in the audience should be doing. I'm just saying you ought to have a process in place where you systematically go through your year and take advantage in the fourth quarter of your tax planning window.
Yeah, Sean, that's fascinating. So basically on the upside, so in this hypothetical, you're early retired, right? Your income is little to none. You have the potential to very specifically create taxable income, right? Purposely in the case of the Roth conversion or tax gain harvesting. But then I guess there's, as we said before, with the ACA subsidies, right? And potentially credits. I don't know if there are any credits that there might be at a very low level, like specific income cliffs we need to consider. But there are the downside, right? Like you want to have potentially create income to pay at a zero or close to zero tax rate, but not make it too high and miss out on credit. So there's a balancing act. And obviously, like you're alluding to, we can't give advice to any specific person who's listening to this, but be aware of that. So I'd love to hear your thoughts on both the up and the downside.
Yeah. So on the upside, it's about converting traditional retirement accounts to Roth IRAs while you're in the 0 or 10% or 12% federal income tax bracket. For some of the high wealth people, even 22 or 24% is a great job. So it's about that. It's about managing this premium tax credit. Now in 2021 and 2022, that 400% of federal poverty level cliff has been eliminated. So there's less management that needs to be done, but that's a consideration as well. So yeah, it's about taking advantage. We live in a low yield world, right? So interest and dividends are really low. So if you're not working and you're early retired, you're not collecting Social Security, you're before age 72, so you're not collecting required minimum distributions. You have this tax planning window and you can get money, you deducted it while you were working at maybe 24%, 30%, whatever it was. Maybe you can convert it to a Roth at 10% or 12%. And you're now doing a great tax rate arbitrage. And then that money in the future will grow tax-free and not be subject to required minimum distributions.
And we've done a lot of examples in the past where we've talked about Roth conversion and we've talked about capital gains harvesting, tax gain harvesting. And Brad, you're right. I'm always doing that through the lens of the marginal tax brackets, and looking to see, all right, with capital gains, you have 0% tax bracket up to some income threshold, and then you have 15% up to a much larger income threshold. And then you're also thinking about your regular income tax bracket. So you have 10, 12, 22, 24 and beyond. And you said this really, really briefly, and this is going to be particularly pertinent to people that are early retired, as many of them are going to be getting insurance via the ACA and the exchanges. You have to consider, although those tax, brackets are real and you can certainly optimize for those, you have to consider the subsidy cliffs for the ACA. You have to. It is a meaningful, tangible change in your budget, as an early retiree. You're talking about on one end being free or $100 a month, $200, $300, and then on the other end going to $1,000+ a month, just like that, snap of the fingers like that. And it's not a phase out, it's a cliff. So, probably outside the scope of this conversation, and you should run that calculation and be aware of those cliffs. But you certainly, when you're doing your planning, because you as an early retiree, Sean, this is the point you're making, you get to decide your income. It's what you want it to be. You decide your income. But the variables are the marginal tax brackets for regular income, the capital gains tax brackets, and then also in parallel to that, those subsidy cliffs for your health insurance.
And just one additional point, though, is the subsidy cliffs aren't cliffs for this year and next year, right? In 2020 and before, they were always cliffs. In 2023 and beyond, they're cliffs. This year, it's much more gradual. So that's just the one little nuance for 2021 year-end tax planning. And then just the big thing is these opportunities, this Roth conversion, tax gain harvesting, these opportunities, they go away January 1st. Now, they'll come back every year, but any year you don't take advantage by December 31st is just it's a missed opportunity. Life goes on. It's okay. But yeah, if you've got an opportunity and it expires by December 31st, you should at least consider action between now and December 31st.
Yeah. And Sean, you talked about how obviously these subsidy cliffs are not there for 2021, 2022. There have been some tax changes, right? Obviously, yes. Amidst this COVID world, there have been some things that have come through. The stimulus and child tax credit planning are two that were on my mind. And I know you highlight them specifically in your article. I'd love to hear you talk through, like, what do we need to consider? Because these are big dollar for dollars, and right, they're credits. So this is, again, it's not a deduction where you're only getting a percentage. This is a credit, which is full dollar for dollar. So what do people have to think about with these two specifically?
Yeah, so I mentioned the income cutoffs for the 2021 stimulus and the new child tax credits. It's basically $75,000, roughly speaking, for single, $150,000 for married filing joint. And there's a phase out, but the phase out is very small. So we try to just get under that 75 or 150, generally speaking. You know, if you're near that range, you're going to want to look at things like, could I throw a little more into my 401k? Could I max out my HSA? It's also, hey, do I want to not pull the trigger on something like a Roth conversion? Now, keep in mind, though, if you already got the stimulus, right? Maybe you don't have children and you already got the stimulus because your 2020 income was very low. Well, then it actually doesn't apply to you. So it gets a little nuanced, meaning if you've already collected that third stimulus check, you got the maximum amount, which is $1,400 a person. If you already collected it, there's no real stimulus planning to be done. You know, it's always nice to get another tax deduction, but not for purposes of the stimulus. But where this really is impactful is, oh, my income was high last year, but maybe there's something I can do this year to keep it low. And then I now qualify for the stimulus. I'll get it with my tax return refund. So that could be very powerful for some folks.
Okay, so what you just said there, the 2021 stimulus was based on 2020 income.
All right, so let's just go through that real quick. Prepayments of the 2021 stimulus, which is sometimes referred to as the third stimulus. This is so easy to keep in everybody's mind, right? So prepayments of the 2021 stimulus were based on 2020 income. The actual stimulus, though, is technically speaking based on your 2021 tax return. So if you didn't get a prepayment of it, you could still get your income low enough for your 2021 tax return and then get it. And here's the other good news. If you got a prepayment of it because your 2020 income was low, and now this year you won the lottery, you don't have to pay it back. It's great. A prepayment is not required to ever be refunded. That's just the way the three stimulus payments worked. So it's heads I win, tails you lose. You know, this is one of the few times the tax rules work in favor of the taxpayer because if you didn't get a prepayment because your income was too high last year, you can get your income low this year. And then all of a sudden we get our stimulus tax credit when we file our tax return.
That's great info because that was my next question. Is there a clawback if your 2021 income was significantly higher? And there's not.
Absolutely no clawback.
That's huge.
Sean, huge thanks to you for coming on the show today and sharing just some of these, really big concepts that can move the needle, whether you're talking about, deadline tax planning for 2021 or really life planning. I mean, tax planning is really a life strategy. It's going to span, every year. You just need to stay abreast of the latest and greatest new rules that are landing, et cetera. We're not done. There's so much more that you could consider. I know, Sean, on this wonderful article, which we'll have linked in the show notes, you also discuss some nuance with state tax planning. I know you're in California, so you definitely have some state tax involved. Required minimum distributions, planning for traditional retirement accounts inherited in 20 and 21, thinking about 2021 federal estimated taxes. So what does the data tell us about this year? How can we improve it for next year? Reviewing and updating beneficiary designation forms, and then long-term financial planning. I would encourage everyone listening to this article to go check out Sean's site. You can find Sean, the FI Tax Guy, at FITaxGuy.com. Again, that's FITaxGuy.com. And the article is 2021 Year-End Tax Planning. Sean Mullaney, thanks so much for joining us on the show today.
Always a pleasure, gentlemen. Thank you so much.
All right, my friends, make sure you take action on this. Go through it, make your checklist, dot your T's, cross your I. Yeah, I'm leaving it alone. The fire is spreading. We'll see you next time as we continue to go down the road less traveled.